Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest signage updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, something unusual is happening inside the crypto market. While headlines continue focusing on Bitcoin ETF outflows, institutional money is quietly moving somewhere else. Over $100 million has reportedly flowed out of Bitcoin ETFs in a single week. At the same time, XRP, the anointed one, related investment products have continued attracting capital. Now, most retail investors see crypto as one giant category, but institutions don't, because the Wall Street, Bitcoin, and XRP are not competing for the same role. One is being treated like digital gold. The other is increasingly being evaluated as financial infrastructure. And if this trend continues, it could signal something far bigger than a temporary market rotation. It could signal the early stages of a structural transformation in how money moves around the world. And once you understand the scale of that system, the implications become enormous. For years, the crypto market operated under one dominant narrative. Bitcoin was the king, everything else was speculation. And to be fair, that narrative made sense. Bitcoin introduced digital scarcity. It created the first decentralized monetary asset. It survived government hostility, market crashes, exchange collapses, and regulatory uncertainty. Institutions eventually embraced it because Bitcoin fit neatly into an existing framework, a hedge, a store of value, a digital version of gold. But here's where it gets interesting. The financial system does not only need a store of value, it also needs infrastructure. And that's where the conversation begins to change. Because while Bitcoin may function as a reserve-like asset, global finance still has a massive operational problems. Cross-border payments remain slow, settlement remains expensive, liquidity remains trapped, compliance remains fragmented, and institutions are now searching for technologies capable of solving those problems. That distinction matters because what we may be witnessing right now is not institutions abandoning Bitcoin. Instead, they may be diversifying beyond Bitcoin. And according to some analysts watching ETF flow data, that diversification increasingly includes XRP. Now, before going any further, it's important to separate speculation from confirmed reality. Bitcoin ETFs are fully established products in major markets. XRP-related institutional products and investment vehicles exist in several regions, while broader ETF developments remain dependent on regulators and jurisdiction-specific approvals. But regardless of product structure, capital flows matter because institutional money trends to move based on utility, regulation, liquidity, and long-term strategic positioning. Not memes, not emotion, not hype cycles. And this is where the entire discussion becomes much bigger than crypto. Because underneath all of this sits a global financial system worth hundreds of trillions of dollars. A system most people never think about. A system built decades ago. And a system increasingly showing signs of strain. Now, this is what most people miss. When you wire money internationally, the transfer usually does not happen directly between two banks. Instead, it moves through an interconnected chain of correspondent banks. That process can involve multiple intermediaries, multiple currencies, multiple fees, and multiple delays. And in many cases, settlement can still take several business days, especially across emerging markets. That means capital becomes temporarily frozen during transfer. And to maintain global liquidity, banks hold enormous pools of idle money inside what are called nostro and vostro accounts. These essentially pre-funded accounts held in foreign jurisdictions. The purpose is simple. Banks need liquidity available before transactions occur, but the inefficiency is staggering. Some estimates suggest roughly $27 trillion globally remains trapped in the system. Capital sitting idle, not invested, not productive, just waiting to facilitate settlement, and that is precisely the problem Ripple has spent years trying to solve. Ripple's core thesis is not centered around replacing governments or overthrowing banks or eliminating the financial system. Write that down, ladies and gentlemen. Instead, Ripple built technology designed to integrate with the existing system. That strategic decision fundamentally separates Ripple from many early crypto projects, because instead of fighting institutional finance, Ripple attempted to work with it. Its flagship payment infrastructure, often referred to as on-demand liquidity or ODL, uses XRP, the anointed one, as a bridge asset between currencies. Here's the basic idea. Instead of banks pre-funding accounts around the world, a payment institution can convert one currency to XRP, transfer XRP across the ledger within seconds, and then convert it into the destination currency almost instantly. No correspondent chain, no multi-day settlement delay, no massive idle capital. required. Now, whether this system ultimately dominates global finance remains uncertain, but the efficiency argument is difficult to ignore. Transaction costs may drop dramatically, settlement speed improves substantially, and operational complexity gets reduced. That is why institutions are paying attention, because in finance, speed matters, liquidity matters, capital efficiency matters, ladies and gentlemen. And above all else, regulatory compatibility matters. But the real shift came when institutions started viewing blockchain technology less as a speculative asset class and more as infrastructure. That change mirrors earlier movements in technological history. In the late 1800s, many investors initially viewed electricity as a curiosity, something experimental, something unstable. But once factories realized electricity could dramatically improve industrial efficiency, adoption accelerated rapidly. The companies that benefited most were not necessarily the ones making headlines first. They were the ones building infrastructure, power grids, transmission systems, industrial networks. And today, some analysts believe blockchain infrastructure could follow a similar trajectory. Not every token survives, not every network succeeds. But the systems that solve real institutional problems may eventually become deeply embedded into financial operations. Now let's talk about Bitcoin, because this discussion is not about Bitcoin failing. Far from it. Bitcoin remains the dominant crypto asset by market capitalization. It continues attracting institutional interest, and its store of value narrative remains extremely powerful. In fact, many institutions likely view Bitcoin similarly to how they view gold, a non-sovereign reserve asset, a hedge against monetary expansion, a long-duration speculative macro asset. But Bitcoin was never designed primarily for institutional settlement. Its architecture prioritizes decentralization and security, not transaction throughput, not compliance layers, not banking integration. And that distinction matters enormously because different assets can succeed simultaneously while serving completely different functions. Gold and payment networks both matter. Treasury bonds and banking rails both matter. The internet itself contains both storage systems and communication systems, different layers, different purposes, and increasingly institutions appear to be evaluating crypto through the same lens. Bitcoin as reserve collateral, XRP as transactional infrastructure. Ethereum as programmable settlement and tokenization infrastructure. Stablecoins as digital cash equivalents. This is not necessarily a winner-take-all environment. It may become an ecosystem, and if that happens, the market may be valuing utility very differently from speculation. Now, this is where history becomes incredibly important. In 1971, the global financial system changed forever. The United States officially ended the convertibility of dollar into gold. That event, commonly called the Nixon shock, fundamentally transformed global finance. Currencies became increasingly fiat-based. International liquidity systems expanded. Cross-border financial flows accelerated dramatically, but the infrastructure supported those flows evolved slowly. Many core banking systems still operating today were built decades ago. And despite the rise of digital banking apps and fintech platforms, settlement architecture underneath the surface often remains outdated. That's one reason SWIFT became so dominant. SWIFT standardized financial messaging between institutions globally, and its importance cannot be overstated. It became the communication layer for international banking, but communication is not the same thing as settlement. SWIFT messages tell institutions what to do, and settlement may still require intermediaries and delays. Ripple's argument is that blockchain-based settlement infrastructure can compress the entire process into seconds. That's the pitch, and increasingly governments, banks, and payment providers are at least exploring it. According to Ripple, hundreds of financial institutions across dozens of countries have interacted with or utilized Ripple-related infrastructure in various capacities. Cross-border payment corridors continue expanding. Asia-Pacific markets have shown notable activity. Central banks globally are increasing research digital asset settlement systems. Now, this does not mean XRP suddenly replaces SWIFT overnight. That's unrealistic. Financial systems move slowly, banks are conservative, governments prioritize stability, and regulatory barriers remain substantial. But the short-term noise, long-term structure, that distinction matters because institutional adoption usually happens gradually, not explosively. The internet did not replace legacy communication systems overnight. Cloud computing did not instantly replace physical servers, and digital payments did not eliminate cash immediately. Infrastructure transitions occur in phases, quietly at first, then suddenly. Now, this is what most people miss. Ripple's biggest advantage may not be technology alone. It may be regulatory positioning. For years, crypto companies operated with a move fast and break things mentality. But banks cannot operate that way. Governments cannot operate that way. Regulated institutions require licensing, compliance, KYC standards, AML integration, legal clarity, and operational accountability. Ripple spent years building relationships inside that system. Some critics argue that the company became too centralized. Others believe that institutional integration is exactly the point. Either way, Ripple's strategy clearly differs from anti-establishment crypto narratives. And that distinction may become increasingly important as regulators tighten oversight across digital assets. Because eventually institutions need permission to deploy capital at scale, especially across borders. Now let's discuss tokenization, because this may become one of the biggest financial stories of the next decade. Tokenization refers to placing real-world assets onto blockchain-based systems. That can include bonds, real estate, commodities, money market funds, equities, even government debt. The appeal is enormous. Programmable settlement, 24-hour markets, reduced friction, improved transparency, faster transferability, and lower administrative costs. Major financial institutions are already experimenting with tokenized assets, not because they want to embrace crypto culture, but because operational efficiency matters. If trillions of dollars eventually move on to tokenized rails, settlement infrastructure becomes critically important. That is one reason XRP supporters believe that XRP Ledger could play a meaningful role. The ledger was designed for speed, low fees, and transactional throughput. Again, none of this guarantees dominance, but institutions are clearly exploring these systems seriously. And once experimentation begins at scale, market narratives can change rapidly. Now here's a powerful historical analogy. During the Roman Empire, roads were not merely transportation systems. They were instruments of economic power. Whoever controlled the infrastructure controlled trade flows, military movements, tax collection, communication, commerce. The roads themselves became strategic assets, and in many ways, modern payment rails function similarly. The infrastructure moving money globally may become more important than the currencies themselves. That possibility is one reason investors are paying attention to blockchain settlement systems. Because the future financial system may not simply be about which asset stores value. It may also be about which networks move value most efficiently. And that brings us back to institutional flows. ETF flows matter because they provide insight into how sophisticated investors are positioning. Again, this does not necessarily indicate institutions are abandoning Bitcoin, ladies and gentlemen. Instead, it suggests portfolio differentiation. Bitcoin fulfills one role, XRP potentially fulfills another. And institutions managing billions of dollars often allocate based on function rather than ideology. Now, some analysts believe this trend could accelerate if regulatory clarity improves further, especially in the United States. The legal battles surrounding crypto have shaped institutional participation for years. Many firms remain cautious due to uncertainty around securities, law enforcement. But as frameworks slowly evolve, institutional participation could expand. That does not mean every crypto asset benefits equally. Regulatory clarity may actually create winners and losers. Projects capable of integrating with compliance systems may gain institutional preference, especially among banks, payment providers, asset managers, and governments. But the real shift came when central banks themselves began exploring digital currency infrastructure. CBDCs, central bank digital currencies, have become a major global research priority. Different governments have different motivations. Some focus on payment efficiency, others focus on monetary sovereignty. Others focus on competition with existing payment networks. Regardless of the motive, the direction is clear. Governments are studying digital settlement infrastructure seriously, and as future financial systems become increasingly tokenized and digitized, interoperability becomes essential. That means systems capable of connecting currencies, networks, jurisdictions could become strategically valuable. Ripple has actively positioned itself inside that conversation. Now, whether governments ultimately choose XRP-related infrastructure remains uncertain, but the company has undeniably spent years building institutional relationships globally. And that matters, because financial systems operate on trust, not just technology. Banks do not adopt infrastructure simply because it's faster. They adopt systems that regulators approve, that counterparties trust, that integrate with existing operations, and that reduce risk. Now, this is where another historical comparison becomes useful. In the early days of global shipping, empires competed not only over goods, but over trade routes. The nations controlling maritime infrastructure controlled economic expansion. Ports became gateways to global commerce. Financial infrastructure today operates similarly. Settlement rails determine how efficient capital moves through the world economy. And in digital era, blockchain networks are increasingly competing to become these rails. Now, critics of XRP raise several important points. Some argue that the network's level of centralization conflicts with core crypto principles. Others question whether banks truly want to rely on public blockchain-bridged assets. Some believe stablecoins or central bank systems may ultimately dominate cross-border settlement instead. Those concerns are legitimate, and investors should take them seriously, because adoption is never guaranteed. Competition remains intense, and regulatory dynamics can change quickly. At the same time, XRP supporters argue that the institutional finance prioritizes efficiency and compliance over the ideological decentralization. From the perspective, Ripple's collaboration approach may actually become a competitive advantage, especially if regulators continue demanding tighter oversight across digital asset markets. Now, this is what makes the current moment so fascinating. We are potentially witnessing the separation of crypto into multiple institutional categories: reserve assets, settlement assets, tokenization platforms, digital cash systems, infrastructure networks. And if that segmentation continues, capital allocation strategies may evolve dramatically. Prices are reacting, the system's evolving. That distinction matters because markets often focus on short-term volatility while missing structural shifts happening underneath. And institutional infrastructure transition rarely happen loudly. They happen gradually through pilots, partnerships, licensing, regulatory approvals, and increasing incremental integration. And then eventually they become normal. Now consider the scale of the opportunity being discussed, ladies and gentlemen. Global foreign exchange markets process roughly $7.5 trillion daily. Let that sink in, write that number down. Cross-border financial flows represent hundreds of trillions annually. Even marginal efficiency improvements inside those systems represent enormous economic value. That's why institutions care, not because crypto is trendy, but because financial infrastructure efficiency directly impacts profitability, liquidity, and competitiveness. Transaction costs decline significantly, institutions save money. If settlement becomes instant, capital becomes more productive. If interoperability improves, global commerce becomes smoother. And if tokenized assets expand entirely, new financial ecosystems may emerge. Now, none of this guarantees XRP captures that market, but the market opportunity itself is undeniably massive, and institutional investors appear increasingly aware of that possibility. That may explain why some capital is rotating towards XRP-related exposure, even while Bitcoin remains dominant overall. Because sophisticated investors often build portfolios around multiple outcomes: Bitcoin for monetary scarcity, infrastructure assets for financial modernization, tokenization platform for digital markets, stablecoins for transactional liquidity. Different tools, different purposes, and as crypto matures, that differentiation may become increasingly important. Now let's zoom out one final time. The broader story here is not merely about XRP or Bitcoin or ETFs. The broader story is about the modernization of the global financial system, a system originally designed for a pre-internet world. A system now confronting digital transformation. For decades, finance optimized around trust intermediaries, banks, correspondent networks, clearinghouses, settlement windows, manual reconciliation. But technology increasingly allows value to move faster, more transparently, and potentially more efficiently. That transition creates enormous opportunity, but also enormous competition. Governments want control, banks want compliance, investors want returns. Technology firms want market share, and blockchain networks want adoption. The outcome remains uncertain, but one thing is becoming increasingly clear. Institutional investors are no longer viewing crypto as a monolithic category. They're now beginning to distinguish between assets designed to store value and assets designed to move value. That distinction could define the next era of digital finance. And if the current institutional rotation continues, it may signal that Wall Street's beginning to position accordingly. Not for short-term trade, but for long-term infrastructure exposure. Because beneath the headlines, daily, beneath the volatility, daily, beneath the noise, daily, a larger financial transformation may already be underway, and the institution's positioning early could help shape what the next generation of global finance actually looks like. So here's the big takeaway. Bitcoin and XRP may ultimately serve different institutional purposes. Bitcoin continues strengthening its role as digital gold, a scarce, decentralized reserve asset. Meanwhile, XRP is increasingly being evaluated as a potential settlement and liquidity infrastructure layer for cross-border finance tokenized assets. One stores value, the other aims to move value. And if institutional capital continues rotating towards infrastructure, focused blockchain systems, the implications could extend far beyond crypto markets, because this isn't just about price. It's about the architecture of the future financial system. But as always, investors should separate hype from reality. Adoption takes time. Regulation matters. Competition's fierce, and no outcomes guaranteed. Still, the trend unfolding right now are worth watching closely, because the short-term noise fades, but long-term structural shifts can reshape entire industries. Ladies and gentlemen, the larger financial system may already be slowly repositioning underneath them. Short-term noise, long-term structure, I always say, pay attention to what's quiet. The price is reacting, systems evolving. If you enjoyed this breakdown, make sure you subscribe, hit the like button, and join the wolf pack, because we're tracking the macro shifts, the institutional signals, and structural changes most people overlook. As always, do your own research. Never invest based solely on a YouTube video. And remember, short-term noise, long-term structure, pay attention to what's quiet. I'll see you in the next one. Well, ladies and gentlemen, hope everyone enjoyed their Memorial Day. This is something that most people I don't think are paying attention to. But before I get into that, I want to welcome all the new members of our Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Remember, one solid tips from the pits can pay for your entire year subscription. Come and join over 560 active traders and investors. Doesn't matter what level of experience you are, who are taking their own financial destinies into their hand, and they want to understand how to capitalize from the volatility and the chaos that's being here presented to us. Ladies and gentlemen, everybody keeps screaming that gold and silver are going to the moon, but almost nobody's asking the one question that actually matters. Who is still buying at these prices? Because when you actually dig into the data, not the TikTok fantasy, not the Twitter hopium or rubbish, not the trust me bro stacker content, the cracks everywhere. And the craziest part, the people screaming the loudest about silver right now are ignoring the exact institutional reports showing demand is quietly rolling over. It's not collapsing. It's not crashing. It's rolling over. And if you understand what that means before everyone else does, you stop behaving like retail liquidity and start behaving like smart money, ladies and gentlemen. Here's the first thing that nobody wants to admit. Silver has gone vertical. UBS data shows silver prices surged more than 140% over the last year. Write that down. That's massive. That's not a normal move. That's the kind of move that changes behavior. And markets are psychological before they mathematical. People think higher prices automatically mean stronger markets. They don't. Sometimes higher prices are the beginning of demand destruction. Look, we get calls every day from the concessions we run, but all the silver spoken for and still being priced at $32 in the ground. It's crazy. Companies want offtake agreements directly from miners and refiners now. There's not enough refining capacity in the United States. But this is exactly what institutional analysts are starting to track right now. UBS literally stated that the elevated silver prices are beginning to weigh on demand in jewelry, silverware, photovoltaics, because buyers are becoming increasingly price sensitive. English translation, the higher prices go, the fewer real buyers remain underneath the market. That matters because momentum traders think price alone creates strength. It doesn't. Professionals know sustainable markets require participation depth, and the participation depth is weakening, ladies and gentlemen. I want you to understand something, and this is what's insane. This is truly insane, and I was on a family office phone call right now going over this. Even with all the bullish narratives online, silver ETF holdings are down over 67 million ounces since the start of the year, according to UBS, ladies and gentlemen. You know how big that is? It's crazy. Think about that and rewind and write that over again carefully. Retail thinks everyone's accumulating. Institutional flow data says investment positioning has already been bleeding out. That's why the market has been stuck in a consolidation range that we call the what-if forest instead of continuing vertical expansion. And this is the difference between watching price and understanding positioning. Price is what retail sees, ladies and gentlemen. Position is what professionals track. Again, now I want to compare this to what's happening in India's gold market right now, and that's where macro gets incredibly important. India just released gold import duties from 16% to 15%. It's crazy. The largest increase on record. That is not a small policy adjustment, ladies and gentlemen. That's a full-scale macro intervention. Why? Because gold imports were becoming a problem for foreign exchange reserves while the Indian rupee weakened more than 7% year to date. Now, most people stop here, but professionals ask the second-ordered question. What happened after governments try suppressing demand? I want to hear your thoughts, if you're still here. And the answer historically is fascinating because according to World Gold Council analysis, higher import duties consistently correlate with increase in unofficial gold inflows and smuggling activity. The financial mercenaries come out in force, ladies and gentlemen. People get caught up like sushi. But as the remora, we don't get caught up like sushi. We feast on this. These are the things that we derive our tips from the pits. These are the things that make or break people, ladies and gentlemen, not financial advice, just my own opinion, and there retains any capacity. That means government can distort official demand, but they cannot eliminate cultural demand. That distinction matters enormously because gold behaves differently than silver during macro stress. Silver is patiently and partially industrial. Gold is deeply monetary and cultural. And India proves this over and over and over again, ladies and gentlemen. You need to think about how powerful this is psychologically. The Indian Prime Minister literally asked consumers not to buy gold for a year. Think about that. And despite that, imports in April still surged above 80% year over year. Do you understand how abnormal that is? You have to understand how normal that is. Most assets require optimism. Gold often thrives on distrust. That's why central banks buying it. That's why families buy it during currency instability. That's why ETF inflows remain resilient even during periods of policy tightening. The World Gold Council reported Indian gold ETFs just recorded their 12th consecutive month of positive flows. Again, that is why surface level analysis gets people destroyed and cut up like sushi, because the headlines say higher taxes hurt gold, but the deeper flow analysis says demand is adapting, not disappearing, ladies and gentlemen. This is the part that nobody in the financial media is explaining correctly. Reports actually describing the same macro environment: sticky inflation, geopolitical instability, currency concerns, rate uncertainty, and institutional hesitation. But gold and silver are reacting differently underneath the surface. UBS explicitly says silver lacks the strategic central bank demand and anchor that gold has. The single sentence is one of the most important things in either reports. Why I say this is because I love reading reports. I go through reports all day. I'm sitting here working right now because I am retained to do. This is all I do. I told you guys before, I was born to do this. I'm married to this game. I am a financial mercenary, pure in, pure out. This game has no breaks, 24/7 financial combat. You get to a certain point in life and you work for certain types of people. This is what it takes. I always ask everybody here, what does it take? What does it take for you to want to take your own financial destiny in your hands? I knew what it took for me, ladies and gentlemen, because it explains why silver volatility becomes structurally more dangerous during uncertain macro regimes. Gold has sovereign buyers. Silver mostly doesn't. That exchange and changes everything. And this is why professionals care about flow composition, not just price direction. A market supported by sovereign accumulation behaves differently than a market dependent on speculative enthusiasm. And honestly, this is where retail investors consistently get chopped and trapped, chopped and chapped, chopped and trapped. They get chopped up like sushi and trapped in their positions. They confuse narrative strength with market strength. They think viral statements equals institutional conviction. But institutions are watching ETF holdings, import behavior, policy response, volatility repricing, physical discounts, inventory flows, demand elasticity, currency pressure, unofficial trade challenges. That's how professionals analyze the market. It's how financial mercenaries we analyze the market. Not with memes, not on Twitter, not with rocket emojis, not with Silver Squeeze 9.0, blah, 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 blah. Hardcore work, determination, discipline, rolling up the sleeves, working when everyone else is partying. Because that's the difference in the moves that make or break careers. That's the difference to people who commit to being a financial mercenary. And ladies and gentlemen, a measurable behavior right now says gold demand remains culturally and strategically resilient. Silver demand is becoming increasingly price sensitive. Those are not the same trade. But here's the warning that nobody really wants to hear, and I spend all my time telling this to anyone that retains any capacity. Late-stage commodity rallies become extremely dangerous when volatility replaces commission and conviction. FOMO comes. And UBS basically hinted at this directly. They stated they do not currently favor outright long positions in silver because expected returns do not sufficiently compensate investors for the associated volatility risk right now. That's institutional language for the upside may no longer justify the chaos. And when institutions start shifting from directional conviction to options-based yield harvesting strategies, you should pay attention, because that's usually when smart money does when asymmetry deteriorates. This is why data matters, ladies and gentlemen. Not headlines, not ideology, not permeables, not dormers, data. Because data tells you what capital is actually doing when nobody's performing for an audience. And right now, the data is showing something extremely important. The precious metals market's no longer being driven by simple inflation fear. It's becoming a complex battle between physical demand, speculative exhaustion, sovereign behavior, currency instability, policy intervention, and investor psychology. That's a completely different environment than most people realize. Most people are going to get cut up like sushi with this. And the people who survive this cycle won't be the loudest. They'll be the ones paying close attention. Ladies and gentlemen, I always tell you to pay attention to what's quiet. This is what's quiet. So this is the key takeaways that I am paying attention to and I convey to people that retain us. Silver prices were over 140% in 1 year, but elevated prices are now damaging demand. Silver ETF holdings declined by more than 67 million ounces this year, signaling weakening institutional participation. India raised gold import duties from 6% to 15%, the largest increase on record. Despite higher duties, Indian gold imports ETF demand remained resilient. Gold is strategic central bank and cultural demand support. Silver does not. Institutional investors are becoming more cautious on silver volatility and directional exposure. Ladies and gentlemen, this is what we're watching. Not financial advice, just my own opinion. Anyone taking any capacity, and also what we go over inside the Crypto Public Desk Monthly and the Patreon. Silver ETF outflows and whether they stabilize. Indian gold import behavior after the tariff increase. Physical gold discounts inside domestic Indian markets. Central bank gold accumulation trends. Gold to silver ratio explanations. Volatility pricing in silver option markets. Dollar weakness and treasury yield direction. Middle East geopolitical escalation. And oil price pressure. Evidence of further demand and destruction in industrial silver. Now, this is why this is important, ladies and gentlemen, because market transitions slowly and suddenly. Most people only react after the price moves. Professionals study the conditions that create those moves before the crowd notices. Right now, the data suggests we are entering a far more unstable precious metals environment. Volatility matters more than narratives. Positioning matters more than headlines. And demand quietly matters more than price momentum. Ladies and gentlemen, if you understand that early, you stop chasing emotion and start understanding how real capital operates. If you want to understand and how to prosper after what I just said, come and join us in the Crypto Public Desk Monthly inside the Patreon. One tip from the pits pays for your entire year subscription. Join over 560 active traders, investors who are taking their own financial destinies into their hand and prospering off of the macro discretionary situations. Ladies and gentlemen, I love you all. I'll be traveling this week. I'm going to have some content with you. I'll be back Friday. I love you all very much. Don't get caught up like sushi. And remember, this content is for informational entertainment purposes only, should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves to never happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink because the world is distracting with noise while XRP continues to develop behind the scenes and building momentum in the broad digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash that like button. Leave a comment with your thoughts. Turn on notifications. And most importantly, subscribe to Crypto Public. We break down the major global banking trends, digital assets today, giving you content, clarity, research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. I'll see you on the front lines.